to see you all on this Wednesday morning. We have a special guest with us here today, Roy Snar. Roy Snar did a breakout at Medicare Con. He's a stud in the financial services space. Very specifically talks about long-term care a lot, and not a lot of people seem to talk about that in a way that's viable. So we're lucky to have him on here today. We're just going to kind of chop it up. What I'd like you to do is write in the comments, if you get a chance, where you are watching from. Again, tell us that you can hear us, so we can make sure everything sounds good. And then if you have any specific questions, please go ahead and throw them in there. If you also would like to ask a question on video or, video, audio, raise your hand as well, because it'll put you up there and then we'll call on you when we get a chance. So thank you for being here. So Roy, thank you for being here, man.
Thank you. I'm excited.
Get close to that mic. Oh. You got to lean in like this. You remember, Larry King?
Yeah.
He always did like this.
That's right. Right here.
Yeah. And David Letterman did it too.
Yeah. So, I got to get used to hearing myself. This is just a trip.
Yeah. No, it's good. It's good. So Roy, tell me, just back, you came into this industry, the financial services industry, how long ago?
About 12 years ago.
Yeah. So you were pretty young then. You were 22.
I was, yeah. I wasn't very focused for the first set of years though. It took about until 2015, I got married, then kind of really got my act together.
Yeah. So cool. Awesome. Well, and you right away were financial services or?
Yeah. So I started off with life insurance, predominantly mortgage protection, mailers, getting into that space, then slowly went to the annuity space and then getting into the long-term care space.
Okay.
Now we do all of it.
Yeah. Now you partner, you do a lot on the long-term care space though, because you'll partner with financial advisors that don't really want to deal with that and do more financial or do more long-term care based conversations.
Exactly. We partner with lawyers, CPAs, Medicare representatives, financial advisors, because nobody really knows that space necessarily. It's kind of like a rare niche. Yeah. And it takes a specialty. So we create that specialty with them. And it also breaks down the barriers of, objections, because the biggest objection in our space is I already have an advisor. Well, I can mitigate that objection by saying, well, I'll do the long-term care then. Yeah. And that gets us into the other ancillary products. Yeah.
And then you've told me before, it also segues into a conversation between you and and that advisor.
Yep.
And say, hey, well, I'll partner with them. And then they just turn into referral partners often as well.
It's beautiful. That's exactly what happens, because I offer to people, it breaks down the walls of barrier, because they already have a guard up generally, because they'll see, oh, you do retirement planning, you sell annuities. I already have a financial advisor, right? No problem at all. Let's get him or her on a Zoom call, or I'll go to the office with you with them. Because what I do is long-term care. That's my main focus, which they don't really have a specialty in. And then the advisor appreciates that transparency, that I'm not coming in there and trying to roll money out for long-term care without their permission. We're all working together as a team. And then they start referring business to us. Yeah. So it's a win-win.
Awesome. You ever get any of them that are like assholes?
Oh, all the time. Yeah.
So you can't be afraid of the asshole for sure, because you're going to find them.
Exactly. And that's where we just ask questions, right? Yeah. And then the advisor gets stumbled and they get pissed off. We've had them yelling and cussing on the phone. And then we had a client get pissed off about that, and then they moved their entire account over to us. They're like, this guy's a jackass. I'm not going to
either get them to partner with you or make an ass out of themselves, and then you get the
correct. Well, that's what's so great about it, because if the biggest thing that they say, my advisor told me I could self-insure. Yeah. I go, wonderful. Have that advisor give you that in an email or write it in a letter and sign it. They'll never do that. Right? Yeah. They're just told that because of a philosophy. And also, you got to look at where the money's made. I mean, if they're actively managing that money and they move it to a stagnant account like LTC, they're not going to make as much.
Yep.
So, yeah.
Perfect. Well, on the long-term care side of things, you do traditional long-term care, but also asset-based long-term care.
Correct.
Right. Is there another, a lot of us don't, some of our people on here probably have gone like traditional long-term care or an asset base, but probably not a lot of activity there.
Sure.
But it's something that people are interested in, because obviously if you find some of those cases, they can be, huge. It can set people up for success.
Oh, very much so.
Yeah.
Yeah. So there on the long-term care side, there's really two avenues. Like you mentioned, you got traditional long-term care, and then you have asset-based. So asset-based is like, you're going to use life insurance or you're going to use an annuity chassis. Traditional long-term care is actually long-term care. It's kind of like a use or to lose it. And the biggest challenge with it is the premiums are not guaranteed. So they can fluctuate. Now, it is better priced today than what it used to be. So we don't actually, I try not to help people with traditional long-term care just because there's so many unknowns about what that's going to actually pay for in the future.
Yeah.
We go more on the traditional or the asset-based route where we'll use like a life insurance policy with an LTC rider or an accelerated benefit. And then if they have assets that are parked, we'll just go ahead and use an asset-based annuity for the long-term care.
Yeah. Awesome. And, and so in the asset base, I know we've talked like One America, I think it's one company you work with very
much so.
Yeah. And on the long-term care side of that, you also, when you partner sometimes with Medicare brokers that are like, cause it's a whole new construct, concept. And so a lot of them don't want to do it. You'll partner with them, refer it, and still be able to pay them commissions. Do you have to get them contracted and things like that with them to split, or how does
generally we do? Depends on the volume. Like if somebody says, hey, can you help my client? And we help them, let's say with One America, we use Nationwide, Securian, Gillico, Global Line. We use them all, right? There's no real buy. It depends on the situation. But if we're able to help them with just one case, and if they're licensed, we may just write them a check, but it's cleaner to get them contracted. And we're not an IMO. If they want to get their own relationship, that's fine. If they need help with contracting, we'll help them. And then they get paid directly from the carrier. So basically, they're just referring this piece of business out that they would not normally have been able to capitalize on. They're helping the client retention ratio. The client's happy, and they can earn an extra $5,000 to $10,000 per client, depending on the size of the case. Yeah. And they're not really doing anything. They're just referring it over, and we're their partner.
Yeah, and you're not writing Medicare or anything like that, so there's no like conflict of interest.
Exactly. I have no idea. I know about Medicare, but I don't write it at all. I've never sold a policy, so there's no conflict. We partner. It's like, hey, look, I do this. I'm good at this. You do that. You're good at that. Let's help the client holistically. Yeah, that's how our approach is. So,
what's a typical like street level or regular commission on like an asset-based long-term care?
Sure. Policy? So there's two types. Let's take a look at the life insurance first, right? So then life insurance, you're paid on target premium. And then we use nothing but we try to, depending on the situation, all guaranteed life insurance. So it has like an index account, but it's also guaranteed premium. And the benefits that are accelerated are also guaranteed and very simple. So on those, you'll probably get anywhere between 90 and 100%, depending on the carrier and the volume that you submit to them on target. And then on the asset-based LTC, the annuity side, on the single premium, you'll get anywhere between 6 and 11% commission. Okay. So it's a pretty wide range. It just depends on the carrier that we go with. Yeah. So, but on average, you can say 7% to be safe.
Perfect.
So if you're able to move 300,000 over in a month by helping, 4 people, that's an extra $21,000 in gross commissions coming through.
I'd come across some of, like I quoted one time, just because I was aware of, I think actually this would have been, it wouldn't have been long-term care, right? It would have been single premium whole life. Yeah. And I just remember, it kind of hit me in the face. It was this lady that was like, I have all this money and that I inherited from my dad, and I don't want my husband to spend it because he doesn't believe in saving or investing. And
since it's a religion, right?
Yeah, he's blowing all of my money, and so I want to put like half of this money into something where I know it gets passed on to my grandchildren, and that's it. I don't want to touch it. Yeah. And so I'm quoting single premium whole life, and but I did get kind of excited because I was like, holy shit, like if this, it would have been like $500,000 going into one single premium whole life. Yeah. It did not close, but had I had you around at the time, maybe we could have, closed it. I don't think I was confident enough in the product or understood maybe how to position it better. So, but it's a great market. And it's funny because a lot of people talk about cross-selling just like a general annuity side, which is great, but sometimes they miss the boat on the long-term care conversation, I think.
Yeah. And it's all
especially coming out of Medicare, like you're already in the healthcare.
You're already talking about it. Yeah.
And then people are bringing it up. I mean, we're notorious for just quoting traditional long-term care premium. And then when they're like, oh, that's too expensive. Or we won't bring it up. Like at 64, this is bad. I'm tell you how all the dumb shit we do, right? We don't bring it up at all. Yeah. And then when they do bring it up, or they're normally like 70, 75, because we didn't bring it up when they were turning 65, which would have probably been the ideal time. Better between 55 and 65, or 50 and 65. Right. But, we don't really see them a lot before 65. So 64, 65, that's when we should probably be bringing it up when they're younger and healthier.
Yeah, and it depends on how old they are too. So if you got somebody in the 40s selling them like an asset-based focused long-term care policy, they're probably not going to use it for 40 years. That might not be the best leverage of the money. That would be more of a life insurance with long-term care play.
Yeah.
You got somebody who's 65. The biggest objection to long-term care is it's too expensive. I can't afford it.
Yeah.
And most people they haven't even received a quote yet, right?
Yeah.
But there's you could quote it online and see that it's $700-800 a month, and that's a lot. It's not guaranteed. They could pay for that 5 years and it doubles. I mean, who knows, right?
Yeah.
But there's opportunities that people can actually park assets that they already have, that they're not necessarily intending on using currently. They have the opportunity to get it all back plus interest if they change their mind, and they don't have to make a monthly premium.
Yeah.
So they can say, hey, look, I have these assets. I'm not using them. How about I park it with an insurance company? It's not my premium. I'm parking it. The insurance company is going to create leverage on it. And then if I happen to need it, I could get 3 to 4 times the amount back in long-term care tax-free.
Where do you find they have this money parked most of the time that you're using? Where is it at most of the time? So
one of the biggest ways to win in this asset-based place is there's only 2 carriers that will take qualified money. So you can literally park IRA money inside of an LTC policy and create tax-free leverage after you've gone through the IRA portion. There's only 2 companies that allow you to do that. And so a lot of times when we're looking at the overall assets, right, for long-term care, it's just like a conversation with life insurance. Well, let's see what your assets are to see how much long-term care that you can need, right? Because a lot of people think, oh, I can self-insure. Well, as soon as I hear that, I go like, well, why are you buying Medicare? You can self-insure.
Yeah.
It's like, so we overcome those objections easily. But generally, they're just by looking at the portfolio. And I get very high level. I said, hey, nothing specific. I mean, I'm not a securities licensed individual. I don't manage money. But I want to help protect your assets. It's all about asset protection and preservation, right? And we got to know high level, what do you have? And so I get all of their account information. So they may have $500,000 in qualified. They may have 100,000 non-qualified. They may have 100,000 in the bank. Out of all that, and based on their health, right, we got to try to find the best type of asset-based LTC play. Yeah. And if it's inside the portfolio, a lot of times we'll just use their cash positions or their fixed income positions that's doing nothing for them and creating 3 to 4 times tax-free leverage guaranteed.
Yeah.
So
perfect.
Yeah. Fun stuff.
All right. So
all right.
Another thing, when you get into, I mean, you know, it's not all long-term care. That's a good in for you on some things.
Correct. Yeah.
But you're doing a lot of, general annuity and
correct.
And I know this is something that's just interesting. It may not help everybody, but
sure.
What is this deal in Texas where you can, you had told me about it. There's some states that allow you to receive like referral commissions on AUM money without being series licensed. Like you still have to, I'm sure, partner with somebody that is
right,
but you can actually receive residual commissions on it in certain states.
That's correct. So one of the things I started investigating, we looked at the total volume of annuity premium, right? And generally when we're helping people, it's maybe 40% of the portfolio at the most. The other 60% is being actively managed or it's used for, long-term care. And so if we took an average of 50-50, so if somebody has $1 million, we help them with $500,000. I'm like, that other $500,000, we're not being able to help the client and capitalize on with revenue, right? So there's got to be a way to do that. So I started bird dogging this. And actually, I was speaking with Ron Ray at Medicare Con. He was telling me about the solicitor's agreement. I was like, whoa, how does that work?
What's it called again?
Solicitor's agreement. So certain states allow that where you can actually get paid a referral commission based on a percentage of the AUM without holding a securities license, like a 65 or 63. But for example, Texas requires you to go down and take a 25-question test. And then you still have to have like these disclosures signed by the client. And then the hurdle to this is finding an advisory firm. You want to go with an RIA because if they have to go through a broker dealer and they're dealing with FINRA, there's no way it'll ever happen. You got to find somebody who's like their own RIA. They're just dealing with the SEC. They're over 100 plus 125 million.
Was Ron offering that?
Not directly to me. He wasn't. We were just talking about different ways to create this.
Because he's series licensed. I know that.
He is. I already have a pre-existing relationship with the firm. So that's why I would have spoken with Ron about it, but I just already had.
But there's an RIA that you found an RIA that would do that for you though?
We're still working through the details because there's so much.
It was very interesting to me because we're starting to do a decent amount of annuity volume.
Yeah.
But we're partnering with some local, money managers, and we just kind of got an agreement with them of like, when we position the annuity part of it, like don't bite the hand that feeds. Like, just take the managed money and
Right.
leave our annuities alone.
Exactly.
And most of them are okay with that because it's free referrals.
Well,
So,
yeah, totally.
And the annuity, it's not like the annuities are bad. Like, they're a lot of times it's something they can't get access to because they're like modern
They're
women or
limited.
something. So,
Yeah.
but anyway, it would be nice if we could do that. Unfortunately, Mississippi was not on the solicitor's agreement that I could find. So I'm still looking for some other.
And we're still trying to figure it out too, because if anybody's out there, you could check with your state. All you got to do, if you go, what I did is I call these RIA compliance companies. So these are these companies that'll just do compliance if you're an RIA, registered investment advisor, right? They'll just do your compliance for you. You pay them a percentage. I would call a couple of those local places and say, hey, look, do we have a solicitor's agreement? I don't have a securities license, but I want to be paid a percentage of the referral money. And you have to think of it this way. Some people say, well, I don't really care. Well, it's your marketing dollars that, you're not being able to capitalize on. And if there's an opportunity to gain just a little bit of it without the headache of a securities license, it's worth it. I mean, the only reason why I'm hesitant is just, it's a whole world of compliance, and life's pretty simple on the insurance side compared to the SEC side.
So Michael Dunn was in here, and he's series license. He's behind the marketing that just, wrapped up. And he's still in town staying for behind the agency. But he was talking about pre-COVID, or actually pre-Trump, I guess, that there was a, kind of an initiative to really, maybe part of the fiduciary rules. So it kind of seemed like they were really targeting insurance advisors,
Department of Labor,
indexed annuities and rolling managed money into indexed annuities. Is that, what have you seen, like the temperature on that right now? Does it seem like it's, obviously you're not hurting the client, but like there's a difference between, like, we all know this. And if you really listen to me, there's a big gap between compliance and doing the right thing for the client. Unfortunately, like, compliance sometimes takes this next step. That's bullshit. But have you seen, any massive hurdles in that, rolling 401ks, index annuity space?
No, not yet. I mean, there's just more paperwork. It's more of a headache. That's really the gist of it. And so the Department of Labor, which when I first started learning about this, I was like, the hell is the Department of Labor got to do with an annuity? It's just weird how the government tries to just screw everything up. So essentially, whenever you're dealing with an annuity or any type of money that's ERISA regulated, right? Like an IRA, 401k, non-qualified, it's still kind of the wild, wild west, but what they're looking at is, if you're going to advise them to roll the money over, you better know what you're doing. You better be acting in their best interest, because the conflict is that they're saying that and this is true, unfortunately, a lot of people who sell like index annuities, they're representing themselves and giving advice on buying or selling. So you have to draw that line. So what we do for ourselves and other agents that we help, we have all these disclosure forms. Right. And they're a little bit erroneous, but they're all approved by attorneys. And it's like, hey, look, they basically say, I'm not a lawyer, not a CPA. I'm just a dumb insurance person. That's basically what it says. Like, I have this massive disclosure. The other thing that people should be doing for their own records is that PTE 48 form. I think that's the acronym of it. And it's disclosing the commissions. That's the big thing. So right now on an annuity app, it'll say, I get compensated. This is what I can and cannot sell, because that's what the states are requiring now. But we go one step above that, and we actually tell people, this is the commission I'm getting paid. That you are understanding that this is an annuity. It's not an investment, especially if you're selling index annuity. It's not an investment. It's an insurance product. It's a transfer of risk, right? So we have all these extra forms. So the agents should do that and document why you sold it. The other thing that they should be doing, that they can keep track of, there's lots of software out there. We actually have one where it'll show, like, if you're doing an income play for an annuity, here's all the top, annuity companies that provide the highest income. It's like, well, why'd you sell this person company ABC? Well, look at this graph on this time, there was the highest paying income. That's what the client wanted. They want to guarantee lifetime income. Great. Just protecting yourself, essentially. And some agents are really nervous. I don't want to tell the client how much money I'm making. I'm like, well, why? You make way more money if you were managing it. Their advisor does. A 1% fee over 30 years could be half of the portfolio.
There's the other side that will buy cars they can't afford when they're investment advisors, because they feel like, if I'm not driving a nice car, why would somebody invest their money with me, or invest or put money? You know what I mean? Like, and totally. Obviously not that either one of those is right, but sometimes people have a preconceived notion based on the way they would feel. Right. And then they carry that forward, and it can, like, make it where they don't take a step because they're worried about, they're going to think I'm making too much money, or they're going to think I'm making not enough. I've lost business both to people who think I make too much money and people who think I don't know what I'm talking about. And
I get it.
but 95% of people don't think in those terms. They think in just like, I like you, so I'm going to buy shit with you.
Right.
So
yeah.
So don't overthink that. Like if somebody knows now, if it's an absolutely egregious commission, then there may be a reason that you're worried about it because it's not in line with what
Correct
actually makes sense. Like there's one annuity company you and Anthony and I talked about that.
Right.
The commission level on it was so high that it would seem like odd that it was even allowable to be that high.
Exactly. And imagine what would happen if that got under review. So why exactly did you sell this company? Well, it's, 12% commission. Why the hell wouldn't I? Right. It's like, you got to be able to prove it. And, most of the carriers, this is what I tell agents all the time. There's 100 pennies in a dollar, right? So if a carrier is willing to pay you this exorbitant amount of money, they're going to be taking away from something. And generally that's the client, right? Yeah. And so that'll come in the form of renewal rate integrity, AM Best ratings too. Like the lower the rating of a carrier, the more they can afford to pay commissions because they can invest more aggressively in other ways.
Yeah.
And so you want to find that balance, and it's to help the client and to help yourself too, because you want to be able to protect both people. So
yeah.
Well,
and so to get into not too detail oriented, sure, but when you just talked about lowering the renewal rates, so a lot of times when people are writing an annuity, they're looking at what the way it illustrates today.
Never happens.
And so what I don't think a lot of them really understand that the cap rates and the averages, right, or all that stuff can change. And so you can literally have an annuity, a fixed index annuity that maps and says this year's cap rate is what X, and then next year they can drop that.
They can. And that's the challenge too, because most annuities never come to fruition. Again, I'm all about making life simple. So how can we erode objections? The financial advisor is going to give two main objections. Your caps and pars can fluctuate. You don't know what you're going to get. And then there's the surrender charge with the market value adjustment, which we can get into that if you want to. But the big thing on renewal rate integrity, you want to make sure you go with a carrier that actually will publish that, maybe not to the consumer side, but to the advisor side. And so we try to work with those companies. Otherwise, what happens is we're good friends, we're high-fiving on the golf course. I sell you $1 million annuity and it's designed for growth. Income annuities doesn't matter. It's guaranteed. Designed for growth. I'm showing you an S&P cap of 10% or 40% par rate. And then 3 years later, it's a 10% par rate and a 2% cap. We're like, Roy, what happened? Well, I'm sorry, Justin, the cost of the options on that index, they've gone up. It's volatile and insurance companies aren't making a lot of money. And so they dropped yours. You're like, well, now I'm stuck in this 10-year contract. I got 7 years left. I can't move my money. And I'm only limiting myself to 2% growth.
Does it ever happen where the market is doing really well and the insurance company is making money and they still drop those because they want to capture more of that prosperity? I mean, that would be, I'm sure that would get them in trouble at some point. Like, they have to make a case to their governing body, like when they do it. So they'd have to be a reason that they're.
Yeah, it has to get approved, like big thing, like the cost, like LTC cost of insurance increase or life insurance COI increase. They have to go through the Department of Insurance, but it's a little bit different on the annuity side. Now, I'm not like an actuary. I don't know how these are exactly designed, but generally speaking, what happens is, and this is a good thing to know because a lot of clients feel that, I only get 40% of the price return. By the way, most companies do not offer total return of the S&P 500.
Okay. Price return, total return. Break that down.
Well, okay.
So you're not an actuary, but you know more about that than me and probably most of the people on here. So
okay, I'll get into that in a second. Okay. I just want to finish this up.
Finish your thought.
So if they're at a 40% par rate, most people think that insurance company ABC is getting the other 60%. They're crushing it. That's why they got so much money. They're not. They're making money on the spread of the bonds that they buy. So at the time you give them $100,000, they're buying bonds and they get a way better deal than us. And then they're going to take a small portion of their profit. They're going to buy options on the S&P 500, for example. If they try to buy an option for 100%, it's too costly. If they don't hit it, they're going to lose money. So they're not making money on the spread difference of the index. They're making money when they buy the bonds because they're guaranteeing you, say, for example, 0, right? So worst case scenario, they don't have to pay you anything. And then that little bit of profit on the options, because options are less expensive than buying an actual fund, then they can make that difference. If it's a volume play for the insurance carriers. So when I talk about price return and total return, this really, none of this is that relevant unless you get really detailed oriented clients, but it's good to know this just in case you do. But most of the S&P 500 funds that you see out there in the index annuity right? They're going to say, hey, look, we'll give you a 40% par rate. Well, that's based on the price return. Doesn't include total return, which is dividends, reinvestments, all of that, which most people have no idea about anyway. I've never had a problem with it. One engineer questioned me on it, but that was it.
Yeah. So like, well, and here's from a strictly a sales perspective. Obviously a lot of people are on one side of this, they kill people with information.
Oh yeah.
And they kill a sell. But there's also people that when they have slight reservation, you can get past it with information. Even if like you say something, like say I'm not sold, but I'm not exactly like completely anti, and I'm in the conversation, but I'm not an engineer. There's that kind of middle ground guy.
Yeah.
And sometimes I can make a small question, and you can say something in a way that I know that you understand it, even though I don't understand it.
Right.
And you added confidence that I like you because you can help me do this. Right. And so having good info is important. It's not the most important thing. Most important thing is really that you're likable and approachable, but being able to answer questions a little bit really does help.
And answer them simply too. I think a lot of agents, what happens is they may be really smart, too smart, and they may get insecure, and they're going to try to prove to the client, I know what I'm talking about. Listen to me. It's like, if a client asks you a question, try to explain it like you talk about, like, could a third or fifth grader understand the response to it? Right. Yeah. So another way to think of it's like, if we go out to lunch today, right? Like if I get into your van, I don't need to know how the motor works in its entirety. As long as you can start it up.
It's my free candy van.
Yeah,
so,
exactly.
If you haven't been here, I have a van, free candy. If he gets in my van,
there's a hot tub in it, which is really weird. But after a few bourbons, it wasn't that weird. But I don't need to understand exactly how that van operates and all that stuff. It's like if I fly back home from Memphis, I'm not going to go speak with the captain and say, tell me what all these buttons do. Right. Yeah. I don't care as long as I get to A to B. And that's what most people are with their money. Look, can this money last me? Can I not lose anything? Can I get a decent rate of return? And can I have guaranteed lifetime income? Great. I don't care what the actuary guy in the basement of the insurance company is trying to figure out. It's not relevant.
Yeah.
So
exactly.
Yeah.
Okay. And going back, you said there was another topic or something you said that I wanted to dive into, but I forgot. It does get detail oriented. We try to add detail oriented stuff because some people stay too high level and then you're not learning anything.
Sure.
And so on the I guess on the carriers we were talking about that pay like super fat commissions,
right?
And they're taking from the client.
Yes.
It's just further. So I'm not going to name the name of the carrier that's doing it, but off the record, I would probably talk to about some of them. And there's some that we've written.
Yeah, but you can text me. I'll tell you.
It's always been like, why are they paying so much more than other people?
Right.
And some of it too, you have to look at maybe another carrier is paying just as much, but they're bonusing out the FMO, the difference.
True.
And so like maybe one of them's passing on more of that to the general hierarchy.
And you can tell too, when IMOs, they'll push a product, a lot of them. I mean, not the ones that we work with because they're good people, but a lot of the other ones will push a product really heavily. Like, why are they pushing that so much? Oh, they're getting a 4% spread on the annuity premium. That's
yeah. I've been shocked at how much the spread on some of them are. Like where we were getting in the past, like there'd be a product you're getting 7% on, you're finding out that they're 12, so they're getting 5%. I'm like, and there's some people out there that they're making just as much when you write an annuity as you.
Yeah.
And I'm like, wow, what a deal
with that guy.
Because in Medicare, it's always like, 2, 3, 4, 5% spread on MedSup, or,
right.
Even the administrative fee over a street agent with Medicare Advantage is never going to be as much as the CMS broker comp.
Sure.
It might be rich, but it's not going to be as much as they're making.
Right. Exactly.
I think that's always really crazy. Now, totally different if you're like providing leads, you're providing office space, like that kind of stuff. But when you're just the upline and you're getting it just as much, because at first, like when I first started, I went to Advisors Excel and went like, to their office, 700 employees, marketing,
it's beautiful,
clients, everything. It's amazing. I'm like, how much is the spread on an annuity? Because how in the world are they paying for all this? Like, because I used to think annuity, like BGAs were on a 1 to 2% spread. And then I'm like, okay, they're putting people at slightly lower levels for a higher service. Sure. And then the, spread can be, 4, 5, 6, 7% even sometimes. So.
Yeah. And it all depends on the volume. I mean, obviously AE, they have a huge they're like the biggest, annuity volume producer right now. And it's like, Yeah. I mean, then they can negotiate with the carriers like, hey, you want our business, you need to work with us and we'll commit X amount. That's how it works. Right?
That's why they got security benefit life only does with AE, but that's in them. There are other Integrity, I think, has a product that only goes through Integrity now, but mostly because they bought some annuity. That's a whole different thing. They just go out and they went and bought a few, and now all of a sudden they're the second biggest in the country. By a collection of multiple people, that's what including Anthony, who just announced. So exactly. But well, it's awesome, man. Well, if anybody has any questions about annuities, long-term care, asset-based protection, you can raise your hand. You can let us know. Put it in the comments. It's a very interesting side of the coin. Roy has been good at talking to us on it, helping us with cases. Getting sometimes we just refer it to him, and then he'll pay us in the back end. Other times he'll help coach us through some different things. And so we wanted to bring him on because that's a value that a lot of you, I feel like, can use out there. So Emily, who's probably in the airport, actually, she may be home now.
They're home. They left at like 3 a.m.
Emily says, great overview. So if you have any detail-oriented questions, let us know. If you have any interest in writing more annuities or writing long-term care, also let us know that and put it in the comments, because long-term care and annuities can bring in some great big money. It's really cool. You could write one annuity case that really gives you a marketing budget. You can write, a handful of annuity cases or long-term care, asset-based, or even traditional long-term care.
Totally.
That can help set you up to invest in the rest of your business. So it doesn't have to be like, I'm going to take my eye off the prize to go for this. It can be combing through my Medicare health insurance prospects, looking for the opportunity.
And now's a golden time because we're going through this recession, or it's going to be a recession, right? So they're going through this time frame, and it's unique because interest rates are up really high right now, relatively speaking. And so annuity companies, that's how they make money, right? And so the annuity rates are phenomenal right now, and the markets are going down. So it's a win-win combination to help the clients diversify further and have that preservation conversation, especially with tax laws too.
Has anybody been getting the MIGA emails right now for like 4.35%, 4.25? Yeah. I swear I saw one that said 4.45. But when I got into the space, MIGA rates, when I first started writing MIGAs was probably 8 years ago.
Right.
And the MIGA rates dipped down lower from there. But when I first started writing them, they were at like 3.3. And there were people that were coming to us like, that's incredible, 3.3% guarantee. And that was even like a 10-year, but you have guys that would just like want to park money on guaranteed annuities.
Totally.
And so it's a great way to be able, like we were talking, to advertise. You get in, you say, yeah, we have MIGA, here's an indexed annuity, and then you compare. And then some of them want to divide it up. Some want to go all indexed, someone will go all MIGA. And then some people say, oh, MIGA commissions are low. Well, it's relative. It's the same people that say, I don't want to help people with PDPs, not understanding it's a door opener, right? That if you help a lot of people with PDPs, you should be writing a lot of MedSup, or there's something wrong with you.
I mean, you do 10 million in MIGA premium, you're probably going to make around $15,000 on average, depending on the structure. And you know how easy a MIGA app is?
Or 10 million, you'd make $1 million, you'd make,
it's like 1.5% usually on average for like a,
so $1 million would be 15,000, 10 million would be 100. Be 150.
Oh yeah, that's right. Sorry. Yeah. 1.5%. Yeah.
So about 150,000.
My math's really good. Now let's roll over your retirement account.
So you do 10 million, make 150,000. Yeah. But if you do 10 million MIGA premium and you didn't do another 5 or 10 million index, you're doing something wrong. And I was that guy. Like I started writing MIGAs, and I was just all I'd present MIGA. And then finally I started just throwing in like an indexed illustration here and there. And I'd have guys that would say, okay, well, I'll take 50,000 of that and put it in an index annuity, which would really help out, and there's still not a tremendous amount of risk to them. There's just a higher potential reward, but a lower floor than a MIGA. That's the difference. It's instead of a guarantee of 4%, I'm looking at, I could hit 0% or I might hit 8%, and it depends on.
And we've been doing that a lot with clients now. Like if we have $1 million portfolio, let's say we help them out with like a 300,000 fixed index annuity, and then they want to leave the rest managed because they love their person, whatever it may be. We'll take like a small sliver, like $100,000, and say, hey, look, how about we just park 100, get a guaranteed 4, and put the rest over here with a higher potential. We don't know which one's going to do better. And that also helps working in the best interest of the client and to protect yourself too, because most agents wouldn't do that. They want all the FIA premium because of the commission, but they have to think this is very long-term, just like you talk about, like, prescription drug plans, and nobody wants to do them, but all these little things add up big time. And a good way to market right now, you can, like where I live in Texas, there's a community that's just with like 14,000 homes, 55 and older. So for Medicare, you'd have to, kind of narrow it down. But for a MIGA mailer, that affects
the whole
everybody.
community. Yeah.
Yeah. So you could have, Johnny's Medicare and insurance services, and we help folks with MIGAs, and then just the biggest thing is your disclosures. You want to be really careful on those MIGAs, but do an EDDM, very inexpensive. You're branding yourself, and you might be able to write a ton of Medicare and MIGA business. And if you get
EDDM's every door direct mail.
Every door direct mail.
For those of you who don't know,
just look at a senior community in your state somewhere and do it.
You're going to get very, very low direct mail cost, because there's no name on it necessarily. It's current resident.
It's like 20 cents postage per one.
So it can get you a really low cost way to hit an entire thing. And if there is like one, even in communities like here, I don't think a lot of the communities would be large senior living, but we might have a neighborhood where I know that the majority of the people in that neighborhood are over 50 years old. And I could hit that. And
they'll become your Medicare clients in time. So whatever.
And heck, if I hit a 40-year-old and they come in and say, I want to give you 100,000 for a MIGA, then I mean, it's crazier things have happened.
Yeah. So, and then you can write their parents.
Yeah. And then you can write their parents. But all right, guys, if you don't have any questions today, this will be recorded and we'll put it up there. If you want to get in touch with Roy, how can people get in touch with you?
Pretty easy. I have a really weird last name, so I dominate Google. Just type in Roy Snar. My website's there, or it's just roy@roysnar.com. You can shoot me an email, and I'll help you out. Give you all the stuff that I've been using and that's working. So
yeah, awesome. Yeah. I put his name in the comments so you can see it's SNARR.
Cool.
And then Roy has been great with working with other brokers, not taking clients or things like that, helping them close some deals. And, that long-term care kind of niche. I haven't met anybody that knows as much about it. That's consumer facing. Like obviously you go talk to an actuary about it, that probably knows a lot about
That's
it.
That's like talking to a spreadsheet though.
Yeah. They don't know anything about how to deliver that information to a client and get the client to, buy into something. So let us know if you have any questions. Thank you guys so much for being on here today. Hope we see you at the virtual Behind the Agency, Behind the Marketing in September. You can head over to behindthemarketing.com or behindtheagency.com to get enrolled in that now. So talk to you guys soon.
All right, cool. Thank you.
It's time to grow your agency like a guru. Introducing Go Guru Pro. The Go High Level platform allows for minimizing software-based subscriptions and grants control over several facets of marketing and communication. Automate your workflow, communicate with your leads, book appointments in advance, and house all your clients in one secure location. Visit goguru.pro and schedule your one-on-one demo today.